Most people ignore the one metric that guarantees a lifetime of financial insolvency. While traditional budgeting tracks where money goes, the personal burn rate measures how fast wealth disappears relative to the passage of time. It is the silent engine behind why many high earners remain functionally broke despite six-figure salaries. This analysis breaks down the mathematics of survival, uncovering why a lower burn rate is often more powerful than a higher salary. Understanding these four pillars will determine if a household is building a fortress or a house of cards. The personal burn rate is a concept adapted from the world of venture capital, where startups track how quickly they exhaust their cash reserves before becoming profitable. In personal finance, it is divided into two distinct categories: gross burn and net burn. Gross burn represents the absolute total of all monthly outflows, from a $3,000 mortgage to a $5 morning coffee. It is the raw cost of existing in one's current lifestyle without any adjustments or cuts. Net burn, conversely, is the difference between total monthly expenses and total monthly income. If an individual earns $5,000 but spends $6,000, their net burn is $1,000 per month, signifying a rapid depletion of assets or a buildup of debt. Fixed costs usually anchor the burn rate, often accounting for 60 to 70% of the total. These are the non-negotiables, like insurance premiums, car payments, and housing, which are difficult to change on short notice. Variable costs represent the discretionary portion of the burn, such as dining out or entertainment, which fluctuates based on behavior. Studies suggest that households with a high ratio of variable to fixed costs have more financial agility during economic downturns. By calculating the total monthly outflow and comparing it to liquid assets, anyone can determine their baseline for financial stability. But here's where it gets interesting. The burn rate isn't just about the money spent, it is about the time that money buys. The most critical output of the burn rate is the runway, which defines exactly how many months a household can survive if all income streams suddenly ceased. This is calculated by dividing total liquid savings by the monthly gross burn rate. For instance, if a family has $30,000 in a high-yield savings account and their gross burn is $5,000, their runway is exactly 6 months. After those 180 days, their capital is exhausted and insolvency begins. The Federal Reserve reports that a significant percentage of adults could not cover a $400 emergency expense with cash, meaning their runway is measured in days, not months. This lack of a buffer creates a cycle of high-interest debt that further accelerates the burn. Optimizing the runway doesn't always require earning more. It can be achieved by lowering the burn. Reducing monthly expenses from $4,000 to $3,000 effectively extends a $12,000 savings fund from 3 months of runway to 4. Financial independence is reached when the runway becomes infinite, meaning passive income from investments fully covers the monthly burn. At this stage, the burn rate is neutralized by the rate of return on assets. While most focus on the size of the savings account, the data tells a different story. The length of the runway is the only metric that provides true security during a recession. Lifestyle creep is the phenomenon where as income increases, the burn rate rises in tandem, often preventing any meaningful wealth accumulation. This is why a surgeon earning $300,000 can have less financial runway than a teacher earning $60,000. Every time a salary increase is met with a larger car payment or a more expensive zip code, the break-even point shifts further away. This phenomenon is often driven by hedonic adaptation, where new luxuries quickly become baseline necessities. Data suggests that for every dollar of additional income, the average consumer increases their spending by nearly 70 cents. This marginal propensity to consume keeps the burn rate high and the runway short, regardless of career success. High burn rates also create golden handcuffs, where the cost of living becomes so high that an individual cannot afford to take a lower-paying, more fulfilling job or start a business. They are trapped by their own monthly obligations. To combat this, successful wealth builders often implement a burn cap, where they refuse to allow their core expenses to rise above a certain percentage of their take-home pay, regardless of bonuses or raises. However, the path to wealth requires more than just defensive spending. It requires understanding the velocity of capital. Wealth velocity is the speed at which one can convert active income into income-producing assets. A low personal burn rate is the primary driver of this velocity because it maximizes the surplus available for investment. Consider two individuals both earning $10,000 a month. One has a burn rate of $9,000, leaving only 10% for growth. The other maintains a burn rate of $5,000, allowing for a 50% investment rate. Over 20 years, the individual with the lower burn rate doesn't just have more cash, they benefit from the compounding effect of that extra $4,000 invested every single month. This can result in a difference of millions of dollars in net worth. Strategic reduction of the burn rate focuses on big wins, refinancing high-interest debt, optimizing tax liabilities, and negotiating recurring contracts like insurance or internet service. These changes reduce the burn without significantly impacting quality of life. The goal is not deprivation, but efficiency. When the burn rate is low, the pressure to earn at any cost diminishes, providing the psychological freedom to make better long-term financial decisions. By mastering the burn rate, anyone can transition from living month to month to building a sustainable financial legacy that outlasts their career. The single most important factor in long-term wealth is not the size of the paycheck, but the gap between income and the personal burn rate. If this changed how you think about monthly spending, the next video breaks down the specific asset classes that can turn a high-burn lifestyle into a self-sustaining portfolio.